My name is Dawn Crouch. I am on this page for you all to see. I'm part of a great team here at Ideal. Ideal has been known for annuities for several years, and we're trying to get the word out. We are heavily involved in the life insurance industry, and we are a growing department. So here we've got myself and our 3 recruiters. Darwin Couch is the head of our life department here, Aaron Clark and Brian King. We are serious about growth, both for our company and especially for your business. We're not only about products. That really sets us apart. We want to be there to help you with case design. We do weekly training webinars just like the one you're about to watch. And we can certainly do specific training for your group if you want to contact us and you have a specific topic in mind. Think of us as a boutique shop where we can provide that hands-on service and help you find that dress that's going to make you look just right. We exist for the purpose of putting you in a much more favorable position with your client interviews. So much so that every one of us has been an agent, and we're just on board. So you can get product anywhere. We're aware of that, and our experience is what sets us apart from everyone else. Every one of us has been agents, like I said, and some of us are still actively in the field writing. And for your information, this webinar will be recorded, so if I go a little fast, just bear with me. So let's talk a little bit about Baltimore Life. Baltimore Life has a B++ rating with AM Best. They've been in the business for over 130 years, and their target market is Middle America. A little thing you should know about Baltimore Life and these products we're going to talk about today, their sales were up 51% last year over the year before, and we're expecting this year to be even much bigger than that. So Ideal, we aim to be your one-stop single premium shop. We've got Baltimore Life. We do an awful lot of National Western Life, Sagicor, Assurity. We've got Lincoln's Money Guard product. And we also have a full line of fully underwritten products to meet all of your single premium needs. So whether you need Simplified Issue or fully underwritten, if you come across a single premium, you ought to be giving us a call so we can give you a hand with that. Here's how you can be a single premium detective. Look for that leave behind money that your clients have. Go ahead and start asking people if they've already paid for their funerals. A lot of people just have money sitting in an account that they consider burial account money. And you could leverage that and buy them more coverage so that there'd be money in addition to what's there left over for their heirs afterwards, and of course all tax-free. With Baltimore's products, we can take annuities that are not needed for income and even unneeded 401ks or other tax-qualified money. Another great thing we've seen agents doing is taking an old paid-up life insurance policy that was bought several years ago, and we can 1035 that cash value into a Baltimore product and get them a bigger death benefit. And of course, I was talking with an agent this morning looking into exactly this scenario. We've got a client had several $1,000s worth of cash value in a UL policy. The comment he made to me was that his client would have to get lucky and die before age 66 for this to be a policy that would have any meaning for them. So we don't want that to be the case. We can take those funds, we can 1035 them into a Baltimore single premium and buy them a policy that will never go away. And of course, a lot of agents are writing single premium with money that's just sitting in CDs. So here's what I want you to do. If you've got a piece of paper in front of you, I want to take a page and just make a line right down the middle because we're going to take some time to go through the 2 products that Baltimore has that achieve one goal, wealth transfer. So we've got the SPWL, the single premium whole life, and then we have a separate product called the Generation Legacy. Both of them are going to achieve the same purpose. They're going to work a little differently. So get ready for a dive in here. And also, if you're in one of those sticky states like Alabama, Massachusetts, Pennsylvania, Vermont, Florida, Utah, Maryland, Ohio, even Indiana, some of those states have problems with products getting approved. Well, I want to let you know up front, these products are both already approved in your state, so don't check out on me. So single premium whole life is going to be the simpler of the 2, and that's going to be for non-qualified funds. The Generation Legacy on the other side of your page, go ahead and write down that we can take annuities or 401k monies, qualified or non-qualified, and it's going to use a SPIA to make that possible. So that's the biggest difference between these two policies. So the single premium whole life, we're going to take whatever money and we're going to dump it directly into a whole life product. The beneficiary is going to receive the death benefit. Very simple. We can write this product from ages 50 all the way to age 85. So this is the broader of the two policies. The generation legacy, we have a shorter window for writing these. We need to be within ages 60 to age 80. We're going to take the money and we're going to put it in a SPIA. And then we're going to take the SPIA, and the SPIA is going to pay the premiums for the whole life policy. Now, depending on the age of your client, it's going to be either a 7-year or a 10-year SPIA. And every year, it's going to automatically do this. Your client's hands will not be in the money. You're not going to have to resell this every year. They'll automatically be 1099s. It's a very smooth, easy product. Something important about this that's not on other policies that do the same thing is that if your client passes away while that SPIA is still paying into the whole life, the beneficiary is going to receive the whole life death benefit as well as the remaining SPIA payments. And that is huge because that can be a substantial amount of money coming to them. So if they, quote unquote, get lucky and die early within those first 7 to 10 years, the beneficiaries are going to get even more than the initial death benefit that we guaranteed them. So that's really worth paying attention to. Again, that's the Gen Legacy. So here's some policy specifics that apply to both policies. They are simplified issue. We only need a minimum of $5,000 to work with. So we can write some pretty darn small cases. You could even consider this a final expense carrier as long as you have a single premium to work with. We can go up to a maximum of about $450,000 death benefit. There is some net amount at risk calculations that go into that. So just contact me and I will be able to tell you the most that your client can put in there if we're dealing with a larger sum of money. What they get is a non-participating whole life contract and a guaranteed death benefit. They are able to make loans against the policy cash value at an 8% interest rate. And because this is whole life, we're not going to be offering any kind of return of premium rider. But I can tell you this, looking at the illustrations, the cash value is going to be about equal to the premium in about year 10, year 11 at the most. And as far as the cash value growth, the policy funds do grow at a rate so that they will endow at age 100. So everything is guaranteed. When you look at an illustration, there is no non-guaranteed column. That is something that makes the sale very easy, especially for clients that we're doing that UL rescue with, where they've had a policy where they were looking at non-guaranteed columns and everything's imploding on them. This is an easy contract to sell because absolutely everything is locked in stone. It's etched in there, no changing anything. Important to note, you can still do a partial surrender after year 1 of 10%, and that does grow so that by the time you get to year 6, you are able to just do a partial surrender and take out almost 100% of your premium. So kind of keep that in the back of your mind. That's not a feature I would emphasize, but your client will still have access to money either through loans or partial surrenders should the need arise. So going back to the underwriting of these two policies, they're treated a little bit differently. The single premium whole life is going to have 8 health questions on the application. And you're going to call up an underwriter at the point of sale and do a short interview where they will go over those same questions. And based on the answers to those questions, your client's either going to qualify for a level 1 or a level 2. Level 1, of course, you might think of that as a little bit more of a preferred rate. Level 2, more of a standard. And we do also have a tobacco, non-tobacco rating with this one. Flipping to the other side of our column, the Generation Legacy, a little simpler, only 6 health questions. Still going to do a point of sale interview, but we only have 2 classifications, non-tobacco or tobacco. Accelerated benefits, they're also different on the 2 policies. The single premium, just keep thinking of that one as being the simpler of the 2. If your client is diagnosed with less than 12 months to live, we are able to accelerate 95% of the death benefit for terminal illness. confined to a nursing home, we can pay 90%. Now, with Baltimore, they are accelerating that with the expectation that the confinement in the nursing home will be permanent. And we do have extended care. That's going to allow your clients to access 80% of the death benefits when your client needs things like home health care, adult daycare, or other qualified care. There is a time deductible on that. I believe it's 90 days. Now, the way it works with Baltimore, it's just a lump sum. Your client's going to have to make a decision once as to how much of the death benefit they want to accelerate, and the maximum they can get in total is $250,000, even if their death benefit is larger than that. So very simple on this side. The Generation Legacy also has the same 3 riders available, but it's going to create a lien against the policy. So the definitions are a little different on this side. Of course, if we're expecting your insured to pass away within the next 12 months, you can accelerate up to 75% of the death benefit, and that loan is going to grow at an 8% lien every year and keep eating away at that. Now, should the policy terminate because of that, you can still repay the lien so that you can lock in your death benefit. Again, it's a smaller percentage, 75%, because we're not expecting your client to live more than 12 months, so we shouldn't run into that. Same thing with the nursing home. By the time we start accelerating that, they're expected to be in the nursing home for the remainder of their life, and we all know most nursing home stays are not terribly long, 2 to 3 years. So growing that 50% lien at 8% should not, by definition, lapse the policy. But it's treated a little differently, and you need to be aware of that. I can go over the specifics with you if you'd like to talk about them further later. Moving on, we need to talk commissions, because that's why you're all on the call today. 13% commission on both of these products. The single premium, the 13% is from ages 50 to ages 79. And then those last couple of years, 80 to 85. I'm sorry, that should be 85. It pays 6.5% for the single premium. Now, the Generation Legacy, the one that uses the SPIA, is also going to pay 13% up to age 74. And ages 75 to 80 is going to pay 2% less at 11%. Now, both of these solutions can work for your clients depending on the source of the funds and what we're trying to accomplish. So when you run across a case, one of us is going to help you pick which of those is going to work best. And at the time of sale, we can help you understand absolutely everything, so it's a nice, smooth, easy sale for you. This is important. Baltimore Life has a convention, and it's going to be in St. Thomas. So if you get serious about writing these products, this time next year you could be sitting on this deck having a drink, looking out at St. Thomas. And the qualification is really reasonable, and we still have until the end of this year to achieve it. It's only going to take $600,000 worth of single premium for you and a guest to enjoy 5 days here at this St. Thomas resort. And this is the Frenchman's Reef and Morning Star. It is a Marriott property. It is all-inclusive. I've been all over their website this morning. It is gorgeous. Can't wait to go. So again, that's for you and a guest. You only need $600,000 worth of single premium. Average case size, probably about 50 to 100,000 is what we see come through our office. So that's in the neighborhood of 6 to 12 policies in the next 8 months. This is extremely doable. And the benefit of course, doing all of your Baltimore production through Ideal is that you're also gaining convention credits for our convention, which is going to be held in Puerto Rico next year. So you can get twice the bang for your buck by doing business with Ideal. Do go ahead and give us a call. We'd love to get you contracted to write these 2 products. Our phone number here at Ideal is 888-433-2507. These are some of our upcoming webinars. Next week we'll be hosting an IUL webinar. And we're just going to make it really easy for you so you can go out and make IUL sales happen. It's a fantastic product, and it pays very well. And it's great for that middle America market as well. So this is Dawn Crouch in Kansas City, signing off with Baltimore Life today. Thank you so much.